First, let us see accounting cycle. This one we call accounting cycle. Okay, accounting cycle every year, every company, every company will go through this particular process. First one, whenever a transaction take place, we will do a document. We call that source documents. Whatever document in a transaction we will collect, the accountant will be collect all the documents, and we will record inside the book of prime entry. We will record inside the book of prime entries. Once we record in the book of prime entries, the data in the book of prime entries will transfer to ledgers. Okay, and then the balances, then we do ledger, we balance up the balances of the ledgers, we list down in the trial balance, and we will try to balance up the trial balance. Once the trial balance balanced, we will do some adjustment on the trial balances. Okay, we do some adjustments, and after we do the adjustments at the end of the year, we will prepare reports. Okay, this is the accounting cycle. Okay, we have 6 steps to complete this accounting cycle, and we go back to the source of documents. The example of the source of documents, can you all remember? Do you remember the example of the source of documents? Okay, example is invoice, debit note, credit note, check, statement of accounts, and also is a cash bill. Okay, these are the documents that we normally will use in a business transaction. Okay, but for now I don't want to explain what is the purpose of all these documents. Okay, the one we do different class. Okay, for today I just briefly explain the process. Okay, all these documents will be recorded inside the book of prime entries. We have 7 book of prime entries. We have a 7 book of prime entries. We all remember what are the book of prime entries? First one, we have cash book, petty cash book, sales journal, sales return journal, purchases journal, purchases return journal, and last one we call that general journal, or we can call that journal also. Okay, we can call that general journal or journal. Okay, altogether we have 7. We have 7 book of prime entries. These are the 7 book of prime entries. All these records that we record inside the book of prime entries will transfer to ledger. Okay, we have 3 ledgers. One is general ledger, or another name for general ledger is nominal ledger, sales ledger, and also purchases ledger. These are the 3 ledgers, and this ledger will transfer to the balances in the ledger will list down in a trial balance. Okay, trial balance we have only one, so no example for the trial balance, and from the trial balance we will do the adjustments. Okay, we have few adjustments before we prepare the end report for the company. Will do adjustments. The adjustments is adjustments for inventory, especially the closing inventory. We'll calculate how much the closing inventory. We have some methods to calculate, and then we calculate our depreciation for the non-current assets. Okay, and provision for doubtful debt. We'll see how much trade receivable that we cannot collect. We'll do the estimation, and then we do prepaid. We will see if there's any income or expenses prepaid, and also we see any income or expenses accrued. So we will do the adjustments. These are the 5 main adjustments that we normally will do in a business. Okay, at last we'll prepare the reports. The reports that normally a standard business will prepare is income statement and statement of financial position. These are the 2 statements that we normally prepare. This is the accounting cycle. We'll start with document and until the report. Income statement and statement of financial. Okay, let's say we prepare a report. Okay, the report maybe income statement. What are the information that we will get from income statement? It's normally profit. We will know how much the profit for the company. So let's say I give you one situation. We have a company A. Okay, and then also company B. We have a company A and company B. Company A earns, or their profit is 20,000. Company B is 2,000. Okay, company A's profit is 20,000. Company B's profit is 2,000. And can I come to a conclusion says that company A better than company B? No, you cannot just judge the company just looking at the profit. You need some other data. Okay, example, this company invests. Okay, invest means the capital. The owner invests into the company A 200,000. The owner invests 200,000 into the business, and then the owner earns 20,000. Okay, it's okay. It's not a bad. It's not bad. Not a bad. It's okay. He invests 200,000. The 200,000 still there. Then additionally he get a profit for the first year is 20,000. Okay, we see company B. Okay, company B's owners invest only 200. Okay, 200 ringgit, 200, and then the owner earns, the company give him a profit of 2,000. So by looking at the capital here, do you think company A or company B is better? I feel company B. Okay, but if we just look at the profit, we might think company A is better than company B. But whenever we look at all the full company's data and then we change our opinion, company B is better than company A. So if yes, the company will prepare the report, income statement and statement of financial position, but just looking at the income statement and financial position, we cannot decide the company good or bad. So to decide the company is doing good or doing bad, we need to calculate ratios. Okay, accounting ratio, we call that accounting ratios. On this chapter, okay, we're going to learn about ratios. Okay, it is necessary to analyze and interpret. Okay, we need to analyze and also interpret the financial statement. Okay, income statement and statement of financial position, in order to business know their performance lah. Okay, and also they need to know their progress. Okay, if a company want to know their performance and also their progress, we need to do some analysis and interpretation. Okay, what is the meaning of analysis? Analysis is the detailed examination. It's a detailed examination on the information given in the financial statement. And interpretation is comparing the result. Okay, interpretation is actually comparing the result to other similar business. We can compare company A and company B. Okay, but we need to make sure the companies are in a similar business. Example, can I compare Petronas petrol station and St. John International School? Okay, it's a school and also Petronas. Can I compare these two? No, because these two are not in the same industry. So can I compare Shell and also Petronas? Yes, they are similar business, so I can compare the results. Okay, we want to compare the company. You must make sure that both companies that you are comparing are in the same industry. Okay, same industry. Okay, we can compare company A and company B, or another comparison that normally the accountant or we will do is compare with the previous year. Okay, first one we can compare with the business. Second one we can compare with the previous years. Third one we can compare with the budget or target. Okay, so before we start the business, maybe we do some budgets. Okay, targets. Then we will compare our actual financial statement with the targeted or budgeted financial statement. So these are the normally three interpretations that we can do. Come to a conclusion whether the company doing good or bad. Okay, we can compare company A and company B. We can compare last year and this year, and also we can compare the budgeted and also the actual. Okay, to enable this comparison to be carried out a meaningful way, yes, we can just simply compare and give some interpretation. But to make sure this comparison is a meaningful, so we will use accounting ratios. Okay, we'll use accounting ratios. In IGCSE, there's only two group. Okay, for as per IGCSE syllabus, we have only two groups, which is one is profitability, another one is liquidity ratios. Profitability ratios and liquidity ratios. Okay, before we continue looking at the formulas, I want you to understand few terms. Okay, few terms. The first one, you need to understand what is working capital. Okay, what's the working capital? Before that, you need to know the formula to calculate working capital. Working capital is different between current asset and current liability. So how to calculate working capital? You take your current asset minus with current liability. Your current asset minus current liability, you'll get a working capital. Okay, so what is the meaning of the working capital? The amount that available, in the business for a day-to-day running business. Okay, how much money that the company have in their hand, okay, to run the day-to-day business. That is the meaning of working capital. Another one, you need to know what is the meaning of capital owned. Capital owned is the money that the invested by the owner, or we can say amount owed by the business to the owner. Okay, how much money the owner give into the business. Okay, next one is very very important. Capital employed. Capital employed. You need to know how to calculate capital employed. Capital employed formula is this: the owner's capital, the capital plus with NCL. So capital plus with NCL. Okay, capital plus with NCL, we call that capital employed. Okay, what is the capital employed? The total fund. The total fund that being used by the business. Okay, being used by the business. How much money they use to start this business, or they to run this business, like how much total money. Okay, maybe the owner's capital is the money that given by the owner, and non-current liability, maybe I take a bank loan. Whenever I start a business, the owner give 10,000 ringgit plus you take a bank loan 10,000. So now you have a fund of 20,000 to run the business. Okay, that's a capital employed. And sometimes the question don't give you, the owner's capital. Sometimes the question don't give you the owner's capital, but the question will ask you to calculate capital employed. So another formula to calculate capital employed is non-current assets plus with net current asset. Okay, what is the meaning of net current asset? Is a working capital. So how do you calculate working capital? Current asset minus current liability, you get a working capital. So non-current asset plus with the working capital, you will get a capital employed also. Capital employed is the same thing lah. We have a two formula to calculate capital employed. Okay, now we see profitability ratios. First, we see what is the purpose of profitability ratios. Profitability ratios is to measure the performance of the company, how good the company performing. And normally, how we decide the company's performance, it is under the profit. If the company earns a good profit, they are doing good. If they are earning a quite bad profit or loss, it is bad. That's how we decide. Okay, that's why we call that profitability ratio, to measure the performance of the companies. Under profitability, we have three main formulas and one extra formulas. Okay, we have four formulas under the profitability. The three main, another one actually we learned already. Okay, we try to list down all the profitability ratio. First one is percentage of the gross profit to revenue. If you just look at the name, percentage, okay, of gross profit to revenue. So the formula is gross profit to revenue. Gross profit divide with revenue times 100. Okay, because if they want the question say they want in a percentage. They want in a percentage, so we'll times 100 to make it percentage. So percentage of gross profit to revenue. This is the first formula under the profitability ratio. Okay, or another name for the first formula is gross profit margin, or they will call profit margin. Okay, gross profit margin, sorry. Okay, they will call gross profit margin. What is the formula for gross profit margin? Gross profit over revenue. Revenue or sales, both are same. This is the first formula. Second formula, we learned this before in incomplete records, markup. Okay, what is the formula to calculate markup? This is the second formula. Markup is gross profit over cost of sales times 100. Gross profit over cost of sales times 100. If the question asks you to calculate gross profit margin, we'll take a gross profit divide with the revenue or sales times 100. If the question is asked me to calculate markup, we'll take the gross profit over cost of sales times 100. Okay, markup also must be normally in the percentage. The third formula is percentage of profit to revenue. Same thing, it's a similar. Okay, so percentage profit to revenue means profit for the year over revenue. Profit for the year over revenue, and then we will times 100. Sometimes the question will call you, the question will label this as a net profit margin or profit margin. They can call this profit margin or net profit margin is profit for the year over sales or revenue. Okay, the fourth formula, the last formula under profitability is return on capital employed. Return on capital employed, or we call this ROCE. What is the formula to calculate return on capital employed? Return means the profit lah. Okay, so profit for the year. But remember this. Okay, if you have a profit from operation, so we'll take the profit from operation. Okay, profit from operation. If you do have a profit from operation in the question, we'll take the profit from the operation, not profit for the year. But number 3, the formula number 3, percentage to the net percentage of the profit to revenue, we always take the final profit for the year. But for return on the capital employed, if that particular question got profit from operation, we'll take the profit from operation. If the question don't have the profit from operation, then only we will take the profit for the year. Okay, this profit for the year divide with capital employed. Okay, wait, just now we got discussed about capital employed, right? What is the formula to calculate capital employed? Do you remember that? Yes, capital plus with NCL. Okay, capital plus non-current liability, we will get return on capital employed. So we take the profit from operation, divide with the capital employed, we'll get return on capital employed. These are the 4 profitability ratio. Okay, now we look at the liquidity ratio. Liquidity ratio, the purpose of liquidity ratio is to measure the ability of the business turn the assets into the cash. Okay, we want to see the ability of the business to turn, okay, to change the assets into the cash and also pay the short-term debts. Okay, their ability to pay their short-term debts. Okay, under here we have a 5 formulas, actually 6, but the major one is 5. Okay, the first one is current ratio or working capital ratio. What is the formula for current ratio or working capital ratio? Current assets divide with current liability. Okay, current asset divide by current liabilities, we call that current ratio. Okay, second one, quick ratio. Second one is quick ratio. Quick ratio, current asset minus inventory. This inventory is actually closing inventory. We are talking about closing inventory. This is our closing inventory. Closing inventory over the current liabilities. Okay, if you compare current ratio and quick ratio, the difference is they minus. In a quick ratio, they minus the closing inventory. Okay, third one, trade receivable collection period, or another name for trade receivable collection period is trade receivable turnover. Sometimes the question will use this name, trade receivable turnover. The trade receivable, the formula for trade receivable collection period is trade receivable over credit sales. Okay, the question must give a credit sales, then times with 365 days. Okay, 365 is for 1 year. Even though this is a leap year, but in accounts there's no leap year, we will follow 365 days. So trade receivable over credit sales times 365, we will get trade receivable collection period or trade receivable turnover. Okay, next one, we have a trade payable payment period. Another name for trade payable payment period is trade payable turnover. Okay, the formula similar to the trade receivable just now. We take a trade payable, okay, divide with credit purchases. You need to go find for the credit purchases and then times with 365 days. So you get a answer. Okay, next one, is number 5, rate of inventory turnover. Rate of inventory turnover, you take a cost of goods sold, divide with average inventory. And if not mistaken, in a club, no, in a incomplete record, we already learned this formula. Okay, inventory turnover. Okay, cost of sales over average inventory. Okay, next one. The same thing. Formula number 6 is the same thing. It's the inventory turnover. But sometimes the question will ask you to calculate how many times, and sometimes the question will ask you to calculate how many days. So now we need to know the formula to calculate inventory turnover in days. So we have it's similar for the other way around. We take the average inventory, divide with the cost of goods sold, times with 365. Okay, these are the 6 liquidity formulas that you need to remember. Okay, we need to remember all these formulas. It's not like maths. They give you the formula in an exam. They don't give you any formula for accounts. So you need to remember all these formulas. Okay, before we do one example, let us recap all the formulas, profitability and liquidity ratios. And also we need to know the answers will be expressed in which unit, what unit. Okay, first one, as percentage of gross profit over revenue. Formula is gross profit over revenue. Gross profit over revenue. Revenue means sales. Okay, can be sales, or can be revenue. Okay, this answer will be expressed in a percentage. This answer will be expressed in a percentage. You take the gross profit, divide with the revenue of the company, times with 100, and then whatever answer that you get, you'll put like a 20% like that. Okay. And then next one is markup. Markup also gross profit over cost of sales. Gross profit divide with the cost of sales. There's a formula. The answer will be expressed in the percentage. In a percentage also. Okay, next formula is percentage of profit to revenue, or another name is net profit margin. Net profit margin. We take profit for the year. Profit for the year over revenue times 100. The answer will be in a percentage also. Okay, next one is return of capital employed. Return on capital employed, we take the profit for the year, but remember, for return on capital employed, the profit here, if the question got give you profit from operation, we'll take the profit from operation. Okay, if there is no profit for operation, then only we'll take the profit for the year. If the company got profit for operation, then we'll take a profit for operation over capital employed times 100. The answer will be percentage also. So all these 4 is profitability ratio. All these profitability ratios, the answer will be expressed in a percentage. Okay, now we move on to the next formula. Next formula is current ratio, or we call that working capital ratio. Current ratios formula is current asset over current liabilities. The answer will be in a ratio. Ratio means whatever answer that you get must be ratio to 1. Example, you get X. Okay, X ratio to 1. This ratio to 1 is fixed now. This ratio to 1 is fixed. This X is whatever answer that you get. Whatever answer that you get. Okay. Next one is quick ratio, or acid test, or we call that liquid ratio also sometimes. Current asset minus the closing inventory. This is a closing inventory over current liabilities. The answers will be same as a current ratio in a ratio. Okay, whatever answer that you get, ratio to 1. Ratio to 1. The ratio to 1 is fixed. Okay, next one is trade receivable collection period. Whenever they say period, okay, it's actually days lah. Okay, so the formula is trade receivable over credit sales times with 365 days. The answer will be in a days. The answer will be in a days. Next one is trade payable payment period, or trade payable turnover. The formula is trade payable over credit purchases times 365. The answer will be in a days also. Okay. Next one is rate of inventory turnover. Rate of inventory turnover. If the question one in a times, the answer will be in a times. The formula is we take a cost of goods sold over average inventory. Average inventory. Or forget to tell you what is how to calculate average inventory. How to calculate average inventory? You will take a opening inventory plus with closing inventory, divide 2. Then we will get a average inventory. Okay, next one is the last formula is inventory turnover. Sometimes the question will ask you to calculate in a days. Whenever they ask you to calculate in a days, inventory divide with the cost of goods sold times with 365. The answer will be in a days, because the question one in a days. So these are the formulas that you need to remember, and this is how we will express the answer. The answer must be expressed in this way. And another one thing that I would like to tell you is, in IGCSE, if the question silent, we always go for 2 decimal. We will always, the answer must be in a 2 decimal, unless the question tell you no decimal or whatever. So if the question is silent, we always go for 2 decimal place. Okay, this is one example. We read the example. Arun is a trader who has been in a business for several years. His financial year ends on 31st December. The following financial statement will be used walkthrough 22.2 and walkthrough 22.10. Later I'll show you the example. So here I can see income statement. We have a revenue, we have a gross profit, then we have a profit from operation and profit for the year. And this is my statement of financial position. We have NCA, CA, okay, capital and non-current liability and current liabilities. The question give me the income statement and statement of financial position. Now we need to calculate all the ratios. We have a profitability and also liquidity ratios. So to do these ratios, I will move on to my another file. Okay, wait for a while.